If you're considering buying and holding real estate, then you're probably already aware that the limited liability company is the best choice for holding that real estate. Now, the LLC is very popular because it offers certain benefits that are available to real estate investors when you utilize this very specific tool for your real estate investing. Number one, the first reason why we like to use limited liability companies to hold real estate long term is that LLC provide two forms of protection. And when I say two forms of protection, what I'm referring to is liability protection. With LLCs, you have both inside and outside protection. Now, this is unique to limited liability companies and limited partnerships. Corporations do not offer this type of protection. And I think the best way to explain this is to show you what I'm referring to. So when you have an LLC set up like this, you're down here, you're what we call the member of your limited liability company. And let's assume that holds a piece of real estate. So you've set up your LLC, it owns this house. Now, the types of protection that most people are concerned about when they create limited liability companies is something happens on the inside of this company. We want to make sure that if our tenants sue us, that we're not going to be held personally liable for the tenant's claim against the LLC or as a result of the property creating the harm. So that's why we boxed up our property into an LLC. Now, generally speaking, across all 50 states, when you create a limited liability company, if you set it up properly, you have an operating agreement, you have a bank account, and you run it the right way, then this company should protect you from the liabilities associated with this asset. So if a tenant were to sue, so this is my injured tenant's right here, his busted leg, he's on crutches, he's trying to get around, and he brings an action against this LLC, then the liability in the lawsuit will stay inside of here, and only the assets of that LLC can be used to pay this tenant's claim. Now, inside protection, as I stated, is pretty uniform. But the other benefit an LLC provides us is what we call outside protection for those things that happen on the outside of the LLC. And so what we're concerned about there is not the property creating the harm. I'm concerned about you being the one who creates the harm. That is, you're the one that's involved. Let's say you're driving down the road in your car, your SUV, and you're involved in an accident. All right, you run into somebody. Now there's somebody lying in the road and they're hurt. So who do they sue? Well, they're going to sue the driver of the car, which was you. And so then they get a judgment against you for $500,000. Your insurance, you recovered to $250,000. So now you have a $250,000 gap. The attorney then will then seek to recover against your assets. So when you own assets in your own name, they can take those assets from you. So your vehicle, they can take that vehicle from you. Any money in your checking account, they can take that from you. Now, if you have business interests that are limited liability companies, this LLC right here, and you own that, you're what we call a member in that LLC, so you have a membership interest. The question then becomes, can they take that interest from you? Now, this is where the states vary in their approach to asset protection. Some states offer what is referred to as charging order protections. And what this means is that if somebody sues you individually, they obtain a judgment against you, then the only thing they're entitled to is a charging order against your ownership interest. Now, in layman's terms, it's quite simple. It means this. If any money is distributed out, okay, because the owner, you're entitled to distributions, if any money gets distributed from that LLC to you, and there's a creditor over here, not from the inside, this is from the outside, this is this guy right here, then those distributions must be paid to your creditor until that judgment is paid off. So if you had a $250,000 judgment and your LLC wants to distribute $20K to you, it's never going to hit you because the court's going to tell you you need to pay that judgment over here to your creditor to pay off that $250,000 judgment that they hold against you individually. That's how a charging order works. Now, other states go one step further. They allow a creditor to go beyond the charging order and basically take your interest from you. So now you actually lose your LLC. The creditor then becomes the owner of your limited liability company. And so they'll take that from you, and now you no longer own your LLC. So this is what we refer to as a foreclosure action. So when you're creating LLCs for real estate, we do it for asset protection, both inside and outside protection. All states will provide you inside protection, but only certain states are going to provide the outside protection. Most notably, I'll give you an example, California, no outside protection there. So in that case, if you had an LLC in California and you want this level of protection to protect you from any personal claims or those brought against your family, then you're going to have to look a little deeper in your planning. And I'm not covering that in this segment. I'm going to cover that in a different segment on how to provide that. But suffice to say that it is achievable. It's just going to create a little more planning around it. So from an asset protection standpoint, LLCs are great for holding property long-term because they provide protection from what happens inside of the box. And in certain cases, they can provide protection from what happens on the outside of the box. Now, another reason why you want to use a limited liability company for holding real estate long-term is we want to take advantage of the pass-through benefits that an LLC provides. A corporation, if you have a C corporation, or to some extent an S corporation, they do not provide the same benefits from a passive income standpoint that we're looking for with a limited liability company that's set up to be treated as a partnership or disregarded for tax purposes. What I'm referring to is the flow-through depreciation. You see, the LLC is unique in its form. With an LLC, the owners of the LLC, what we call the members, they can participate in the business. So if I own rental real estate, what I mean by participate in it is that I, either as a member or as a manager, make decisions with respect to how that property is being handled. If I'm making decisions about that, such as setting rents, determining who to rent the property out to, any type of decision, then I'm entitled to take certain real estate deductions with respect to this property. Namely, what most people realize on their tax return would be depreciation deductions. If you're depreciating your property because you're required to do so under law, and you have paper losses, meaning that you brought in cash, but your depreciation offsets all the cash that you brought in, you can take that off as a deduction on your 1040 under very specific circumstances. The circumstances are as follows. If you own rental real estate and you earn under $100,000 a year, then you're entitled to reap up to $25,000 in those types of deductions that you can use to offset your income. So if I make $100,000 in working for GE and I have a bunch of rental real estate and it shows $20,000 in paper losses, I can reduce my $100,000 in income down to $80,000. Great, there's a huge savings there. Now, as you creep above the $100,000, the government starts to take back 50 cents of your $25,000 limit for every dollar above 100. So by the time you hit $150,000 in earnings, let's say GE came to me and said, Clint, you've done such a great job, we're going to give you a $60,000 raise. And I jump up and down and say, great, I'm just making an extra $60,000 a year. But now that I'm over the $150,000 limit, that $20,000 I realized on my prior year's return will no longer be available to me because I can no longer take it because I've made too much money. And what I'm referring to here is what we call active participation. When you own rental real estate, you have two different levels of participation that you can meet, tests that is. One is active, and the active participation level test states that you make some decisions regarding your property. You know, as far as how much you want to rent it for, tenants, who you're going to put in there. Maybe you go out and you clean it up when a tenant moves out. Okay, those are the types of decisions the IRS says if you do something with respect to your real estate, you just don't turn it over to somebody else to handle and you just step back and collect a check, then you actively participate. And if you actively participate, then you're entitled to write off up to $25,000 in paper losses against all other forms of income. But again, they do take it away from you. So once you've earned $150,000 in other forms of income, they determine that you've made too much money, and so that deduction is no longer available to you. Now, if you don't fall in that category, if you fall in the category where you're making over 150 and you have all these real estate deductions, then the other option is to qualify for material participation. Now, material participation requires that you're actively involved in your real estate. It also requires that you spend at least 750 hours a year on real estate related activities and 50% of your time. Now, in that circumstance, if I work for GE full time, then I will never qualify for material participation because they don't satisfy the 50% prong test. So you have to have 50% of your time and 750 hours on real estate related activities to get those types of deductions for material participation. Now, why is the material participation important? Because if I made $180,000 and I had $40,000 in real estate losses on paper, I could use all of that 40, and so my net income for the year would be 140K. You'll see that I'm not subject to the $25,000 limitation that active investors, active participants are, and I'm not subject to the income limitation either of $150,000 where I'm completely phased out because I materially participate. So that is a test that many people who own a lot of rental real estate strive to obtain. But what holds them back is typically either the 50% or the 750 hours. Now, this one's easily rectified. Keep a logbook showing how much time you spend on your real estate, and then make an aggregation election on your 1040. That's key. Aggregation election to treat all your activities as one activity. You can satisfy this. This one's more difficult. If you're not in a real estate field, you don't work full-time in real estate, you work full-time in some other job, then you'll never satisfy this test. So that's a problem. Also, what can hurt you is how your structure is set up. So that brings us back to the LLC. Because as a member who makes decisions with regards to the LLC, you can have asset protection in here, and these times and hour requirements will be attributed to you. Whereas if you'd set this up as a corporation, you're not treated the same way because shareholders do not run the day-to-day business of the corporation. They're not involved in that. So then you would be precluded from taking advantage of these deductions over here because of the way it's set up. Another thing that you run into is if you try to use a limited partnership. You'll notice that I talked about this in the corporation section, having a limited partnership set up for flipping property. Well, if you own rental real estate inside of a limited partnership, the number one problem people have is that they cannot satisfy either the active or the material participation test. Because when it's in a limited partnership, although it's a flow-through entity, it's taxed as a partnership, just like an LLC could be, limited partners do not work inside of the limited partnership. They make no decisions. Because they make no decisions, they can't satisfy either the active or the material participation test. It may be kind of confusing to you, but just think of it in these terms. From an asset protection standpoint, we want liability protection. An LLC provides that, keeps the liability contained in the box. From a tax standpoint, we want to be able to benefit from the fact we own rental real estate. We want passive income. We want long-term gains, short-term gains. We want to be able to write off our depreciation. So in order to capture that, then we want a flow-through entity that gives us those benefits. And that's what the LLC is going to do for us if it's taxed as a partnership or a disregarded entity. It's going to flow down onto our 1040 and it's going to be carried on our Schedule E. Now there's one caveat to this, and that is you haven't heard me mention S corporations, choosing to have your LLC taxed as an S corporation. There is a certain situation where you would want to move beyond partnership or disregarded status and elect to have your LLC taxed as an S corp. This situation is when you earn over $250,000 a year. All right. When you earn over $250,000 a year in income, the government will impose upon you an additional tax. It's called the net investment taxable income, or NITI for short, or even better, Obamacare tax. That's what they refer to. And it's 2.5% on your income above $250,000 that you generate from sources like this, from rental income, from rental real estate. So if you have a LLC that's treated as a partnership or a disregarded entity, either one of those, then the income you generate from here, let's say you made $30,000, it's going to be subject to taxes, ordinary income taxes, capital gains taxes, or if it's rent, it would be ordinary income. And in addition to that, you're going to get hit with 2.5% on top of that because you make over $250,000. Now, the way we structure around that additional 2.5% is instead of having this entity taxed as a partnership or disregarded entity, we change its tax status to S corporation. Now it changes the nature of that income, the way it flows down onto your return, and it takes it out of this net investment taxable income regime, and you'll save 2.5% on your income. So when you're thinking about structuring your real estate, your rental real estate, you have to be concerned about asset protection. That's where the LLC is going to come in. And then you want to make sure you're going to tax it the right way. So you're not overpaying in taxes, getting hit with taxes you didn't know about possibly, and you can still satisfy the active or material participation when it comes to these types of entities. Now, the next issue you run into is going to be, where do you file this entity? That is, where do you set it up? Do I set up an entity that in the state where the property is located, or do I put it in a different state? Well, that's an important concept, and that's going to be covered in a different module. Be sure to look for it.